subscribe now and press the bell icon. Never miss an update.
All right, let's just focus on now royalties and rental income. So royalty, and what is meant by royalty? Anyone? Tania, what is royalty? What kind of income can be called as royalty?
Usually it's given on books and it is like part percentage of the sale is given out to the owner.
Right. So it can be on books, it can be on any intellectual property, it can be on software, it can be on anything which is creatively developed or which is developed by a person, because the person has put in a lot of efforts in it. So, and if he's letting others use it, then the royalty goes back to that person. So, royalty are payments to an owner from people who use a right belonging to that owner. So, the owner is giving the right to you to like to buy, read the book, or to use the license, or to access something like a program or whatever. Okay, so this is where the royalty can be given. And royalty is always ordinary gross income. It is not a dividend. It is always a business income. It's a gross income. It's like the authors keep receiving royalties for lifetime. As long as their books are getting sold, they keep getting royalties. Usually, softwares are not going to be that much. They don't have a very long life because the technology keeps changing. But they also get royalties as part of the license agreement that they're letting somebody else use it. What we need to remember, it is a gross, ordinary gross income. And this is royalty. What is now rental income? If we see that there is royalty coming, and we may see that some professors are there, they publish their articles. If the article is used by other universities for the purpose of teaching to their students, or something like that, then they receive royalties. So if we see a royalty, if we know, like if we have a client come to us and saying that I've received royalty income, we should understand that this is not a special income. It is considered to be a ordinary business income kind of thing, ordinary gross income. Any expenses related to royalties can be deducted. Any ordinary and reasonable expenses. You cannot just say that, hey, because like I'm going on vacation and I want to deduct that as part of my loyalty expense. No, but then if you're going and promoting your book somewhere and you're holding some kind of like authors meet, or that kind of, or you're going to some conference, you're going to some book show or exhibition, and that's where you're meeting new people in order to promote your book, yeah, that can be taken as an expense which is deductible. Anything which is reasonable and necessary for the income to be generated. What is reasonable, what is necessary? IRS is not going to give us a list of that. We have to use our own professional judgment to see what is reasonable, what is unreasonable. That's more of the professional judgment. Sometimes it's more of common sense that we need to use. It's not even professional. It's not like we need to have very high degrees to even understand that. Something we need to like really apply the common sense. Like, does that really make sense? And if we think it doesn't make sense, then we can always tell the client that, okay, we cannot take that expense as a deduction. Or otherwise, if you really want us to go ahead and take it as a deduction, you need to convince us, give us more proof that this is a reasonable and necessary expense. Otherwise, we can't take it. Second one is rental income. Quickly, we'll see. Anyone remembers on what schedule do we put rental income? Wait a minute, let me ask someone. Vinita, do you know?
Yeah.
What is
Yes,
it?
Schedule E, page 1.
Wow, you receive a brownie point.
Thank you, thank you.
Schedule E, okay.
She just couldn't wait to answer.
I know. She's like,
Yes.
as if she was just waiting for her name to be called up.
Yeah.
Yeah. So it always goes on Schedule E. But if the person is in the business of renting out properties. Let's say like the co-working spaces, what people do is they lease huge spaces from the owner and then they sublease it. So that becomes more of a business. You are basically you're taking you're renting, you're taking some space on rent, and then you're breaking it into different small areas or pieces, and then making some changes to it, and then selling each unit out, saying that okay, one small company can take 5-seater office, can other company can take 10-seater, or people can just go and buy one seats at a time. So you are into this business. Co-working companies, they don't have their own rental, buildings and all. So they always have to lease it from somewhere and then sublease it. So that becomes a business. If the person is doing this kind of thing, we cannot say that the person is running a, person has to report it on Schedule E. It becomes a Schedule C income because that's more in the nature of business. But if there is an individual who has some investments made in some properties, which could be commercial or residential or farmhouse or anything, and it's not that person's main business to rent out those property, maybe that's on the side. Maybe the main business is doing job somewhere or running some other company or doing something else. Okay, in that case, we will take rental income on Schedule E. And what kind of income does that become? Shweta, what kind of income does that become? What is the nature of that income?
Business income.
Nope.
Property income, ma'am?
Nope. There is a special word for that, and that's what I'm looking to get it from you. Tanya, anyone else, if they want to try it out?
Passive income.
Exactly. You got another brownie point. Yeah, that's passive income. Why? Because this is not an active activity. If it was active, Shweta, if you're saying it's a business income, then it has to be an active activity, right? It has to be like somewhere where person is like really making some efforts every day. But when you rent out a property, you don't make an effort every day. Maybe initially make some efforts, go and meet brokers, go and meet tenants, and do other stuff and all. Make sure the property is like in a rentable condition. Get all repairs, maintenance done, whatever. Put it up on rent, then fine. It just goes on its own. There could be small repairs, maintenance that could keep coming up, but that doesn't take your time actively what other business would have taken. So it's definitely not an active income. It's not a business income. It's just continue to be a passive income. And when we are talking about passive income, there are always certain restrictions that may come up if you are claiming passive loss. What IRS says is you cannot keep reducing your active income with your passive losses. So we will put a limitation there. We'll put a restriction there that say if you're having $10,000 of loss, we will allow you only 2,000. Rest of 8,000 needs to be carried forward because it's passive. If you are having an active income, let's say if in Schedule C, if you have $10,000 loss, they will allow you to take the entire loss and maybe you can reduce your salary income. Let's say if you're also having a job and you're also running a business. So we have to understand rental income is more of a passive income. If it's reported on a Schedule E, if it's reported on a Schedule C, it's more in the nature of business income. Okay. Any any value that is given in lieu of rent, that becomes landlord's income. There is no such rule that you have to pay rent only in cash. You can say, well, if you give me this room to rent out, I will teach your kids for free. Okay, like maybe that's also value given. Or I'll make sure if the person, like I'll make sure that I do your company's books or accounts or whatever. So it doesn't have to be everything in cash. We have to see what is the value which is given back to landlord, what could be the fair market value of that service which is provided, turn that into dollar amount and put that up as rental income. Obviously deposits are not rental income, right? When the tenant is giving a deposit which is a regular norm, like some 2 month 3 month deposit, that's not an income, because that's always refundable. But when the deposit is being applied to the rent, then it becomes income. So we always have to go into the depth of the transaction, try to understand. Some people may say, well, I received, like, my rent is like, say, $2,000 a month, but, like, for the rest of the 3 months I received only $1,000. We should ask why, what's going on, why did you reduce the rent? That doesn't look like a fair market rent. So what's it? Maybe we'll come to know, well, that person was giving me some other services and I didn't pay for that. So maybe reduce the rent. So we have to just get into the depth of the transaction and try to understand what it is. Schedule E is not used to report income and expenses from the rental of personal property such as equipment or vehicles, all those things. I mean, cars are given on rent, machines are given on rent, trucks or buses are given on rent, and all those things. So that we don't use Schedule E for that. That's more of a business income. Schedule E is meant only for uh, real properties, real estate properties. Value received by a landlord to cancel or modify a lease is gross income. Sometimes there is a penalty clause that if there is a 1 year lease signed or 2 year lease signed, but if you want to come out of that lease before it gets expired, there might be some penalty there that, okay, you pay this much and then you come out of it. So that is the amount paid to cancel a lease. That becomes their income. That becomes the income of the landlord. Amount received by a lessee to cancel a lease, however, treated as amount of disposition of an asset, property, a capital gain. Yeah, leave it. Usually, what we are seeing, this is again they're talking about the personal property. So anything which is given to maintain the property in lieu of rent, sometimes the landlord, the tenant may say, well, I'll pay property tax on your behalf. They'll say to the landlord, you don't need to pay that. Or if the gardener is coming every month to maintain the gardener, we'll pay for it. So instead of landlord paying it, the tenant is paying directly. So that's a value which is being given to landlord. So that becomes part of rent. Any improvements which are done by tenant, maybe the tenant will say, well, this thing is broken, I want it to be fixed, or the ceiling is like getting cracked, and whatever, we'll get it fixed and all. But whatever expenses we are incurring, we will adjust rent with it. Obviously that also becomes a rent. But if the tenant comes and says, well, I don't like the color of this the paint that you have done, and I like only pink color, so I'm gonna paint the entire house as pink. I mean, landlord would say, well, fine, that's your expense. If you want to do it, go ahead and do it. So that does not become part of rent. Okay, so we have to understand what actually is going on, what is the substance of the transaction there. um, There's another rule, 15 days. We always have to see if the property is rent out for less than 15 days. IRS just gives some kind of relaxation there, that okay, you're renting your place only for like less than 15 days a year. Don't even bother to report it on a Schedule E. It's fine. Leave it. But if you're renting it for more than 15 days, definitely you'll have to report it. So that 15-day also we need to see if the client comes and says, well, I have a vacation home, I just rented out for 5 days, like in a year, rest of the time it was closed. You can very well say, well, forget about it, don't even report it. Yeah, okay. So there's another thing called not-for-profit rental income. There's a lot of times people give their house or part of the house or some property for rent to for some not-for-profit purpose. That means they don't intend to make profits out of it. So that doesn't need to be reported as income. But there's some form obviously we need to file. It's called Form 5213. And what is the condition that IRS is putting? That at least 3 years out of last 5 years, at least 3 years, if your income is more than expenses, okay, maybe you don't intend to, whatever, but your intention is one thing, but what your books are showing is that you don't intend to make profit, but you're actually making profit in 3 years out of last 5 years, then we are not going to consider that as not for profit. You please report that, pay taxes on it, and then this will be considered as for profit rental activity. And you obviously have to report this form 5213. Hold on. So, where were we? Okay. Okay. Let's go over this. Bhavani, can you read example 2.20?
Yes, ma'am. Payments of lessee in lieu of rent. While a taxpayer is out of town, the finance in the taxpayer's rental
Furnace.
property stop.
Yeah, the furnace in the taxpayer's rental
His
property
rental
stops
property
working.
stops working. The
Right.
tenant pays for the necessary repairs and deducts the repair bill from the next rent payment. The repair bill paid by the tenant and any amount received as rent payment are included as rental income. The taxpayer may deduct the repair payment made by the tenant as a rental expense.
Right. So the what is the important thing to note here? Bhavani, can you tell us what is the important thing to note here? Sakshi, can you tell?
Ma'am, necessary repairs are paid by tenant.
Mhm.
So these should form part of rental income.
Right. So it's landlord's responsibility
Yeah,
to get this
yes.
repair done. It's not tenant's responsibility.
Okay.
So that's why if tenant is paying for it, it should be added to income. Now, another important point is even though tenant is now, let's say the rent is $2,000 per month, the expense to get the repair done is $1,000. So maybe one of the month tenant is saying that I'll pay only $1,000, right? Because I'm offsetting that expenses. Everyone understood this part?
Yes,
Rohit,
ma'am.
able to
Yes,
understand?
ma'am.
So what the tenant is saying, I'll pay only 1,000, and the property was rented for 12 months. So for 11 months, tenant paid $2,000 each, and for one of the month, he paid only $1,000. But what is the total gross rent that we're going to report on Schedule E? Now this is for Anurag.
24,000.
What is it?
24,000, ma'am.
I cannot hear you.
24,000.
24,000, right? Even though
Yes.
the cash actually going out is 23 from tenant to landlord. But we need to make sure the gross payments are put up properly. Why it is so important? Because a lot of calculations revolve around the top line. What is the gross payment? That's very important. We cannot reduce the gross by these expenses or adjustments and all. Those expenses will come below. There is a section to put all the expenses and all. So we must put it over there. Okay, so that's an important point. When you're actually doing the work on the rental income and all, always try to ask what is the agreement. Whatever is coming cash and all, that's different. But what actually is the agreement? If the agreement is $2,000 per month, we should see 24,000. If it's not coming, we need to understand why it is not coming. Or maybe it is adjusted some other way. Okay, but the gross line should be $24,000 in majority of the cases, unless there's thing like COVID or lockdown, or people are not able to pay and all. That's different then. Okay. So with this is a very small thing we have already done with it. Let's just quickly start with the next one. Income in respect of a decedent. Decedent meaning the person who has died. If the person has died, how do we ensure what income is being reported on the person's, on the deceased person's last tax return? Okay, and what should go to the person's state? So IRD, that's again important. It will come up only when if the taxpayer has died during the middle of the year. We need to understand what is the income that needs to be reported on 1040, and what could be the income that needs to be reported on the state returns or some other returns. So the filer of a decedent's income tax and state tax return is required to make the appropriate allocation of income related to decedent during the year of death. IRD is all amounts to which a decedent was entitled as gross income, but that were not includable in computing taxable income on the final 1040 return. So that income actually belonged to the decedent, but again, it is not considered. There is a difference between IRD and not IRD, income in respect of decedent. We need to understand that. So the person actually had earned the right to receive it prior to death, but it did not get credited to the person's account. Okay, so this could be a bit confusing. Let's just see some of the items. So again, we have to pay attention to what is the method that the taxpayer is following. Are they going for cash method or they going for accrual method? So obviously, if it's a cash method, then not includable on the final income tax are the amounts not received. Why? Because we are following cash method. If we don't receive it, we don't report it. And accrual method, anything which is not being accrued, we don't have to report it. So we need to understand what is the method that usually in the case of individuals, they'll go with cash method. But the salary is earned, not yet given, that becomes like accrual method. So we also need to understand what's going on there. Wait, we'll just go over some of the example that will be good for us to understand. Okay, maybe let's just go this example. 2.21 items of income in respect of a decedent. So what is IRD? Salary earned prior to but not received before death of a cash method taxpayer. So anything that person has earned but still not received. So we call it as IRD, meaning income in respect of a decedent. Okay, if that income was already received, we just report it as a regular income on the 1040. There's no distinction with that. So anything with he should have received but he didn't receive it, it was not received before death, it becomes IRD. Collection after death of accounts receivable of cash method taxpayer. Again, it's a cash method. So accounts receivable are coming after the death of the person. So we will say, yeah, this income belongs to this person only. But this is IRD, it's income in respect of a decedent. It will not get reported on 1040. It will get reported somewhere, but not there. Okay, so this is how they have given a lot of those lists. Let's go over this. What is not IRD? any salary earned and accrued by accrual method taxpayer. So if it's an accrual method taxpayer, or the taxpayer is following accrual method, then the salary is earned, it needs to be reported as income. So if you've earned the salary, we are reporting it as an income on 1040, then it is not IRD. Then it becomes a regular income, which we are reporting. IRD is the income that does not get reported on 1040, so maybe it will get passed on to state tax, or to states, or to some inheritance, or to the people those who are entitled to after the death of the person, all those things. So that again becomes important because it gets added as part of state taxes. State tax, ESTATE. Okay, state tax is a different kind of filing that needs to be done. It's different than 1040 filing. So we need to make a proper distinction what goes on 1040, what will go on state tax. So if the rent is received before death, it will become as 1040 income. So it will go on 1040. Okay, so we'll just see one of the example. And it has the same character it would have been in the hands of the decedent. So if it's a salary income, let's say the salary income is received by trust, or it's received by the state. State will also report it as salary income. It will not change the income. It will not say this is other income. If it's rental income that was supposed to be received by deceased, but now it is going to a trust, we will also put that as trust's rental income. So it retains the same character. That's what they're saying. IRD is taxable as income to the recipient. It is included in gross state. But it should not happen that we are including that income in 1040 also and the state tax also. So obviously that's not the intention, that you get this income taxed twice. Only one person needs to pay the taxes. Okay. There's some form that they're talking about, a state tax return form, that's called Form 706. This is state tax return. Basically, if there is a state, we have to, report those assets every year. And there's something called state income tax return. If the state's assets are earning income, we report it on 1041. So it's important. We don't need to get confused over here. We just need to see if the person has died, what is the income that he has received? What is the income that will later on go to? It's his own income, but it will probably go to somebody else. Then that becomes part of state. And also when we are working on state tax return, we have to see how to report it on 706, because the value of probably the states have increased. That's what they're talking about here, that maybe the basis has changed. So we will report the new basis. Or maybe the state is just generating some income. So we have to do it on Form 1041. Double deductions not allowed if there are any expenses related to it. Either you take it on 1041, either you take it on 706, but it's not like we are taking deductions at two places. Okay, we're not going to spend too much time on it. We just need to understand if it's cash basis. What is the rule for cash basis? Muskan?
Then when you received it,
Yes.
when it is earned and you received it.
Right. When it is actually coming into the bank, that's cash basis.
Yes, ma'am.
So if it's actually coming in, then it becomes 1040 income. But if it's not, it's coming after the death of the person, then it becomes IRD income. Okay, that's what there's a cash basis, accrual basis. But that's not true for accrual basis. Whether the person has received it or not, we can take it. Okay, so we need to understand, like, what income to report on 1040, what not to report, and what income will go to the state or somebody else, whosoever is entitled to receive it. Okay, so let's just read this thing, this example. Rohit, you want to read?
Yes, ma'am. Right to receive IRD transferred basis. Mrs. Hart had earned a 2 week salary of $2,000 that had not been paid when she died. As a cash method taxpayer, her basis in the right to receive the $2,000 was $0. When her estate received the income, it had $2,000 of ordinary income because its basis in the right to receive it was also $0. Note that the $2,000 is not reported on Mrs. Hart's final income.
Yeah, when they're saying Mrs. Hart's final return, that means Mrs. Hart's final 1040 return. Because she's on cash basis, she has earned 2 weeks salary and then maybe she died, but she didn't receive it. But she had always been reporting her income on cash basis. So what we'll say is that we will not report this income on her final 1040. We will say that this is a IRD. It needs to get reported on her state. So when the state receives the income, state will say, okay, we received income of $2,000. And that becomes completely a state's income. Now, basis and all what they're talking about is like, is there any cost to it and all? No, there's nothing. There's nothing that can get deducted. It's like the salary income. So there's no basis that we're talking about. So entire income becomes state income. She is on cash basis. That's why she's not reporting on 1040. Her final 1040. So, but somebody needs to report, right? We cannot say that, oh, okay, fine, like no one is paying taxes on that. Someone needs to pay taxes. So, what is it? Maybe it goes to her state. The state will pay taxes. Okay? And again, this is like, this we're going to focus more on this when when the taxpayer have states and all, when we're talking about inheritance taxes. I mean, in simple situation, it may not even be applicable because W2 has been issued and all, so you just take W2 and get done with it. Okay, any questions on this? Okay, then we're just gonna stop here, and I think with this we have already finished second chapter. We're gonna start with third, which is going to be focused on some deductions or expenses that can be claimed.